Good morning. It's still morning. Connor and Kristen, good morning.
Good morning.
Kayla, good morning.
Good morning.
James, good morning.
Good morning.
I can only say that for a couple of more minutes and then I have to start saying good afternoon.
Yes, sir.
Did you guys get the so-called memory aid that I typed up and sent out to you?
Yes, sir.
Cool. I'm waiting for a couple more minutes for others to join, and I have some things, a couple of little things to discuss before we get into the material for today. Just curious, but when I speak at this level, can you hear me? Cool. By the way, if you happen in checking over that 4-page memory aid, if you find mistakes in it, please let me know. I'll fix it and send it back out. Ideally, it's mistake-free, but that would be unusual for me. Okay, let's go ahead and get started. Today we'll get into chapter 12, which is really the third in the set of chapters. Chapter 10, we looked at the cost of capital. 11, capital budgeting techniques like NPV, IRR. With chapter 10, with a whack, my wife's in the kitchen making racket. With chapter 10, with a whack, we determined the rate of return a project has to beat to be acceptable. You know, if the WACC is 10%, then the project's expected rate of return has to be higher than 10% for it to be considered acceptable, a good project. In Chapter 11, we looked at the different techniques that we could apply to projects, and we made use of the WACC with most of those techniques, but we were given the cash flows. What we do today is we sort of back up and look at how we come up with those cash flows. That's what we're doing today. And these three all together show the approach that companies use to analyze really big projects like building that Nissan factory. Basically, to see if it's a good idea or a bad idea. In my opinion, we should have covered Chapter 12 before 11, but hey, I decided to go with the authors. So, Chapter 12, estimating project cash flow. I put on there and risk analysis, but we're not going to cover that. The risk analysis part we skipped. We're only looking at project cash flows. And we define what we're looking at, or for, I should say, is incremental cash flows. Now that looks like kind of a wonky definition, but it makes sense. What you want to look at is the company's cash flows with the project, that is, if they accepted, less what the company's cash flows would have been without the project, that is, had they rejected it. Incremental means change. You do the same thing. It's intuitive. If you're in a job and you're making $50,000 a year and someone offers you another job where you'd make $70,000 a year, you don't focus on the 70 and you don't focus on the 50. What you focus on is that extra 20 that you'd be making. You look at the change in your income, the increment. Companies do the same thing. Now, one of the things you'll discover in this chapter is you're flooded with information. When we look at the proposed capital budgeting project, we're flooded with information. So we use kind of a divide and conquer approach to make it more manageable. We divide a project's cash flows into three segments. The initial outlay, that's the cash flow we'd have to come up with now at time zero if we accept the project. The annual operating cash flows, that's really the annual cash profit. If it's a 3-year project, then we're looking at 3 years of cash flows. If it were a 5-year project, we'd be looking at 5 years of cash flows. And then when we shut the project down, we look at any remaining cash flows we've not accounted for. We call that the terminal cash flow. If it's a 3-year project, this would come in year 3. So we need to think of it as an extra cash flow in year 3, if it's a 3-year project. Divide and conquer. Now, what I want to do is first just walk you through the information on this project. MD Corporation is considering a new project, an expansion project. If they accept it, they'll have to buy equipment that'll cost, well, basically $100,000 installed. It's a 3-year project, and they believe that for the 3 years, this project would contribute another $130,000 to sales. It would incur another $40,000 in cash operating costs for things like labor, materials, and so on. The equipment would be depreciated as MACRS 3-year property. I'll show you what that means in a minute. Not a biggie. And because they'd be operating at a higher level of production, they'll have to carry more inventories in stock. Their receivables will go up because they make sales to their customers on a credit basis. And their accounts payable would go up because they would be buying more from their suppliers. They also believe at the end of the 3 years, when they shut the project down, they can sell this machinery for $35,000. Now, that's before we consider the tax effects. We're also told that MD's marginal tax rate is 40%. Anytime you engage in decision-making, financial decision-making, you use the marginal tax rate. If you were making $50,000 and offered a job of $70,000, to see what the taxes would be on that extra $20,000, you'd use your marginal tax rate. Some people call that a person's tax bracket. And the cost of capital for projects like this one, 15%. To come up with our sales estimates, we spent $10,000 on a marketing survey. That money has been spent and it has been expensed for tax purposes. And finally, this project is part of a big company. It's just one part, proposed new part of a big company. We're assuming that the sales from this new project will have no impact on the sales of the other products and services of the company. You know, obviously, if Apple, took me a minute. If Apple comes out with a new iPhone and they project sales, the sales of the new iPhone would cost them sales of existing models of iPhones. So they'd have to take that into account. Here we're assuming no effect. So divide and conquer. Here we go. The first segment of our cash flows is the initial investment outlay. That's the cash flow that would occur at time zero if we accept the project. Obviously, one thing we'd have to do if we accept the project at the start is buy the equipment. And that would be a $100,000 outflow. But something else we would have to do is invest in the working capital. Now, by definition, working capital is current assets minus current liabilities. We believe we would have to carry $5,000 more in receivables because we'd make sales from the new product project to your customers on credit. We'd have to carry 20,000 more in inventories in stock to support the project. And we'd buy more from our suppliers, so our accounts payable would go up. If you net this out, you get a $10,000 increase in working capital. The question is that an inflow or an outflow? The simplest way to see it, what if the only item that was going to change was inventories? And everything, there'd be no change in receivables or payables. If we had to stock more inventories, buy more inventories, working capital would go up by 20,000. Golly. So you tell me, if we're buying more inventories, is that 20,000 an inflow or an outflow? It'd be an outflow. We'd be buying more inventories, so the cash would be going out. The bottom line is an increase in working capital is a cash outflow. So we would have to buy the new equipment, we'd have to invest in more working capital. So our total cash outlay at time zero would be 110,000 outflow. And that would be, for our project, the cash flow at time zero. That's segment one. We're 1/3 done. The second segment is the annual operating cash flows. You need to think of this as annual after-tax cash profit. Same thing. One approach, the easiest approach, is to take every item that would land on the income statement and express it in after-tax form. For now, skip slide 11. I'll come back to it. Okay. So one thing we're expecting sales to be higher. 130,000 higher. But if we look at this item alone and its tax effects, if sales went up by 130,000 and nothing else happened, then taxable income would go up by 130,000. We would have to give up 40% of it in taxes. Which means we get to keep the other 60%. So our after-tax sales revenue would be 78,000. And if we do this for 3 years, that'd be 78,000 a year. And of course, sales land on the income statement. Something else that lands on the income statement is operating costs. We expect our cash operating costs will go up by 40,000. And since it's a cost, that's why I've got that negative sign in there. However, operating costs are tax deductible. We would actually have from the $40,000 deduction, if you can lower taxable income by 40,000 and you're in a 40% tax bracket, that would produce tax savings if I'm in a 40% tax bracket and I can reduce my taxable income by 40,000, that would save this thing, 16,000 a year in taxes. So yes, I'd pay 40 more for labor, materials, and whatever, but I would also save 16,000 in taxes. So the net cost would be 24,000 after taxes. My cash operating costs after the tax savings would only be 24,000 a year for each of the 3 years. Then the other, and that lands on the income statement. Another item that lands on the income statement is depreciation expense. Only depreciation expense is not a cash expense, but it has a cash effect because it's a deductible expense. It allows us to lower our taxable income. So for example, now we're depreciating this equipment on the 3-year schedule. These figures will be given to you on the exam. You know what's really funny about what they call 3-year property? It takes 4 years to fully depreciate it. So after 3 years, that would represent untaken depreciation. I simply want to mention that, stick it in your pocket. We'll come back later and talk about that. But note that if we take 33.33% times 100,000, our depreciation expense in the first year would be 33,330. In the second year, that figure, and in the third year, that figure. That's the way MACRS depreciation works. You multiply the percentage by the cost of the equipment, the so-called depreciable base. So these would be our depreciation expenses. We get to lower our taxable income in year 1 by over 33,000, year 2, 44, year 3, nearly 15. So what does that save us in taxes? Well, if you're in a 40% tax bracket and you could lower your taxable income by 10,000, that would save you 4,000 in taxes. You multiply the depreciation expense by the tax rate, and that shows you what your tax savings would be. So notice it is different for each year. That's because the depreciation schedule is kind of wonky, it's uneven. So on our income statement in year one, we'd have after-tax sales revenues of $78,000, incur after-tax cash operating costs of $24,000, and generate tax savings from our depreciation deduction of over $13,000. And we do the same kind of thing in year two and year three. So our operating cash flows for the 3 years would be these figures if I didn't make a math mistake. Now, this is the shortest approach. Take every item that would land on the income statement, like sales, any kind of cost figure, and of course, depreciation, and figure out the after-tax effect and add them up. But another approach you could use, and we're going to do this just for year one, a different approach, it's a little longer, but some students are more comfortable with it, is you build an income statement. If we did this for year one, we'd start with sales, which are $130,000, subtract our cash operating costs of $40,000, and in an income statement, depreciation is an expense. So we'd also subtract our depreciation expense. That gives us taxable income. Knock out our taxes, which would be 40% of that 56,670. That gives us book income. Book income is not cash income. To convert book income to cash income, we look back up at any item that we deducted that was not a cash deduction. And sure enough, depreciation expense was deducted, but it's not a cash deduction. Simplest adjustment, we add that back in. So we build an income statement, run it down to net income, then add back in depreciation. And notice it gives us the same operating cash flow. The other technique did. I don't care which way you do it on an exam. Either way is fine. Either way should result in the same figure. So we're 2/3 done. We've found the cash flows for years 1, 2, and 3 from operations. Finally, we look at the terminal cash flow, that extra cash flow in year 3 when we shut down the project. And these would be any cash flows we haven't considered yet. One cash flow would be the salvage value of the equipment after taxes when we sell it. And something else that would happen, whatever we invested in working capital, we would expect to recover. That is, we'd collect the remaining receivables, we'd sell off what's left in inventories, and we'd pay off our suppliers' accounts payable. Now, by default, your author in every problem, I in every problem, and every problem on your exam, we assume whatever we invested in working capital we recover at cost. And that gives us our terminal cash flow. So our federal government is kind of particular about depreciable equipment. If you sell depreciable equipment at its book value, our government says no gain, no loss, no tax effect. But if you sell it at above book value, you have to pay taxes on the gain above book value. Now, there are two ways to get book value. This would be book value at year 3. One is the way they taught you back in accounting. You could take the original cost of $100,000, then subtract the 3 years of depreciation. That'll give you book value. But a shorter method sometimes is to use untaken depreciation. And if you recall, that was at 7410 we had not yet taken. That would be the book value of the equipment after 3 years. And also, if you recall, we think we can sell that stuff for $35,000. So our forecast is we'd be selling it at quite a bit above book value. Our government would make us pay taxes on that gain above book value. And in our tax bracket, that would produce an additional $11,000 plus in taxes. So our actual salvage value after tax would be that $35,000 we think we can sell the equipment for, less the $11,000 we have to pay in taxes. Basically, we expect to sell the equipment for $35,000 and then for the federal government to swoop in and take over $11,000 of it. So that would leave us with an after-tax salvage value of $23,964. So to summarize, our salvage value after taxes would be $23,964. We would recover the initial working capital outlay, and we assume it costs. So if at the start our working capital investment was a negative $10,000, now at the end, in year 3, it would be a $10,000 inflow. And if you add these up, that would be $33,964. I think on your slide, it probably says $23,964. That's where my math failed me. Please make that correction. Voila, we're done. For the project, we've got an initial outlay of $110,000. Cash operating profits of $67, $71, and $59 for the 3 years, plus a terminal cash flow of almost $34,000, Look at that. I still didn't fix that. For a total cash flow in the final year, since the year 3 cash flow from operations and the terminal cash flow, they both occur in year 3, we can just add them. You probably have on your slide 83,888. Again, my math failed me. That should be 93,888. And by the way, I'm making corrections to the slides and then sending them back out to you. You should get them back sometime later today. So that's our project. This is, in the prior chapter, what we would have started with. And in the prior chapter, to see if the project is acceptable, we would have applied one or more of our capital budgeting techniques. For example, we were told the cost of capital is 15%. Again, my math failed me. If you crank it out for the cash flows for the project, we get a positive NPV of 64,500. So what would our decision be? Since the NPV is greater than 0, we would accept the project. So now, well, do you have questions? I go too long without asking for questions. Do you have questions on anything that I've done at this point? All right, let's look at the green slides. And forgive me, but I'm going to jump around on you. When you get them back, I'll have them in better order. Jump to slide 26, if you will. The Wynn Corporation. Now, what you're going to see in these examples is what you'd see on the exam. The problem would be too long to ask you to come up with all of a project's cash flows, but I might ask for a certain part. For instance, Wynn's considering buying a new machine that'll cost $200,000. The new machine would require working capital of another $40,000 in inventories, $50,000 in receivables, $25,000 in accounts payable. And Wynn's marginal tax rate is 30%. What would be the initial investment associated with this project? So if we work it, here's our information. The cost of the equipment, $200,000. The working capital, another $50,000 in receivables. Delta means change, so that'd be an increase. Another $40,000 in inventories. And in accounts payable, we would expect expected to rise up and stay at a level of 25,000. This is what we expect these three accounts to average for the 3 years of the project. But initially, we'd have to make this as an investment. So what would be the cost of the equipment? What would be our initial investment? Cash flow at time zero. Well, for one thing, there'd be the cost of the equipment. So that'd be a 200,000 outflow. And then we'd also have a change in working capital, which would be the change in current assets minus the change in current liabilities. Receivables, we think, would go up by 50,000. Inventories, which is another current asset, would go up by 40,000. And then the one current liability would be a payables, accounts payable, which we think would go up by 25,000. That'd be an increase in working capital of 65,000. But since an increase in working capital is an outflow, we would show this as a working capital investment of 65,000 out. So our initial cash outlay, that is the cash flow at time zero, a negative 265. You'll also notice maybe two things. We were given a tax rate of 30%. Did we use it for our initial investment? Not really. Some professors refer to that as smoke. Additional values that you'll be given that you don't need. Why? To test you, to see if you'll bite on it. Now, also, if you look at the slides, I had the wrong check figure. You probably have 251, and that's not correct. It should have been 265. When you get my revised slides, that will be corrected. Notice the nature of the problems on the exam. You'll be asked for part of a problem. You may be given all the information for a capital budgeting project, but only has to find the initial outlay, or for example, and this is slide 26 in your slides. This should have come right after 27, forgive me for that. When you get them back, they'll be in better order.
Professor Cudd, could you go back to where you worked out the last problem for just about 2 seconds? I missed the last the notes on that.
That?
No, sir, where you worked the problem. Yes, sir, that.
You're as bad as me.
Okay, I'm good. Thank you.
All right. And, you know, this is recorded and it should be posted by tomorrow afternoon. So you can also look at the recording if you want to go back and check something. But it was fine to check it now. Okay, so same company, Wynn's considering purchasing a new machine. Oh, wait, sorry, next slide. There we go. Wynn's thinking about buying a new machine. Again, it'll have a $200,000 cost. It's expected to have or generate annual sales of $300,000 a year and annual cash operating costs of $140,000 a year for each of its 3 years of operation. Again, we're told that Wynn's looking at a 30% marginal tax rate. And again, it will be depreciated. Well, not again, but it will be depreciated as MACRS 3-year property. And if you looked at the table, you could go back if you want to slide, 11? You'll notice the percentage for year 3 is 14.81%. Fine, we've got information. What is being asked for? What is the incremental operating cash flow just for 1 year, year 3? So, to work this, what are we given? Sorry, I lost my, here we go. We're given that the change in sales for years 1 through 3 will be 300,000 higher. The change in cash operating costs, I guess I can get rid of that one. Sorry about that. Cash operating costs will be 140,000 a year. And what else were we given? The depreciation percentage for year 3, 14.81%. We're given the cost of the equipment, which was 200,000. And we're given a tax rate, 30%. And we're asked to find the operating cash flow just for year 3. So we'd want to look at what the sales would be after taxes. Yeah, we'll generate another 300,000 each year, but the government will take 40% of that, leaving us with, forgive me, I'm doing this kind of on the fly, 210,000. And this is just for year 3 is all we're looking at. It would actually be 210 for each of the 3 years. The change in the cash operating costs will incur 140,000 but because that's tax deductible, we'll have tax savings of 40% of that. So the really cash out of our pocket would only be the 60%.
Should that be 40% or 30%?
Boy, thank you, thank you, thank you. Whoever said that. Who was that?
It was me, Jason.
Thank you, sir. You
Yes, sir.
saved me. Yeah, 30%. Yeah, the tax rate's 30. I went to sleep. Actually, the 210 is correct. I just didn't write it down correctly. So 140 times that would be 98. Even though we'll spend 140 a year more on things like labor and materials, because that's tax deductible after taxes, it'll only cost us 98. And then for the depreciation tax savings, we'd take the cost of the equipment times the depreciation percentage. Now, that would give us the depreciation for year 3. That would be allowed to deduct. But to figure out what it would save us in taxes, we then multiply by the tax rate. So we take the $200,000 cost of the equipment, so-called depreciation base, multiply it by the depreciation percentage we're allotted, which is 14.81%. So that would give us the depreciation expense, but then, and this time I'll remember, to figure out what it would save us in taxes, we multiply it by the tax rate. In other words, our depreciation expense would be 29,620. So we'd get to lower our taxable income by 29,620. Since we're in a 30% bracket, that would save us $8,886 in taxes. And that's a tax savings. So that'd be a positive number. If you net all these out, that'd give us our incremental operating cash flow in year 3. So let's see, that plus I'm getting 120,886. And by Jove, that's my check figure on the slide. I got that one right. Any questions on this? Let's look at one more to this WIN Corporation. This would be your slide 23. Sorry about that. Like I said, when I get these back, the order will make more sense. WIN forecasts that if it buys this new equipment costing $200,000, by the way, same problem, they can sell it after 3 years for $50,000. That's what they think the salvage value will be. and they believe their initial working capital investment will be recovered at cost. So what is the terminal cash flow for this wind project? And it's not a replacement decision. More corrections. It's an expansion decision. So what would be the terminal cash flow? Well, first let's see what we know. Borrowing some of the earlier information, we know that the cost of the equipment is $200,000. We know wind's tax bracket is 30%. We know that the working capital investment at t equals 0 was 65, right? 65,000. And we know that the untaken depreciation after 3 years of depreciation, the untaken depreciation will be 7.14% of the cost. So, again, our government's kind of funny when it comes to depreciable equipment. Oh yeah, I forgot the one other thing. We were given what? Salvage value of 50,000. So if we try to sell a depreciable asset for 50,000, our government's going to compare that to its book value at the time. Well, the book value of this equipment in year 3 would be its cost and like I said, sometimes the shortest method is to multiply that by the untaken depreciation. So if we've got a piece of equipment that costs 200,000, and after 3 years, we'll have taken everything but 7.41%. So that would be a book value of 14,820. And our government will compare the book value to the salvage value and determine, in this case, we'd have a taxable gain because we've got a salvage value. We think we'll sell it for 50 when it's carried on the books at 14,820. So our government would look at that and say, well, you've got a taxable gain of 35,180. And the tax on that gain, well, it'd be our tax rate times that gain, taxable gain. So 30% applied to a gain of 35 and change would give us taxes of 10,554. So our salvage value after tax would be what we think we can sell it for, which is 50, minus what we would have to pay in taxes. Coming up with 39,446. Basically, we expect to sell the equipment for 50,000, but then we expect the government to swoop in and take 10,554 of it. So that leaves us after the tax effect with 39,446. So to get our terminal cash flow in year 3, we'd have the after-tax salvage value of 39,446, but we would also have the working capital recovery, if that working capital investment was a 65,000 outflow at the start, it equals 0. Then at the end, the recovery would be a 65,000 inflow, giving us terminal cash flow, that extra cash flow in year 3 of 104,446. Questions? All right, let me take a couple of minutes to talk to you about your final exam. All right. We're not going to use ProctorU. Instead, I'm going to proctor you by holding a Zoom meeting. When is your final exam? Is that Friday at noon? Somebody give me an amen.
Yes, it is.
Okay. So what you want to do, Friday, a little bit before noon, jump into our Zoom meeting. I think I've already sent you the invitation for it. Join this, just like you did today. Only have your camera and mic turned on. Unlike today where I'm looking at your names, I want your camera on. Between now and then, in fact, just for grins, well, wait, I don't know how many of you are. Some of you may have your hair in curlers or something, I don't know. Anyway, you'll log into the Zoom meeting, and then you go to Moodle and click on, I forget what it's labeled, Fin 341C final exam. Click on the final exam, and it puts you in that exam. You'll have 3 hours. I'll be watching you the whole time. I'll be the proctor. You're allowed to use the memory aid I sent you. You can't create your own. You're not supposed to write on it, although I don't know what else you'd write anyway. Have any of you even looked at it yet? Out of curiosity. It amounts to it's 4 pages, so print it out and have it with you when you take your exam. Earlier, I'd said I was going to post it in the exam. I'm not going to do that. That's another source of possible error. So you just print it out, have it with you, you can use it. It's pretty thorough for the problems. 2 things about the exam. It's going to be worth 200 points. I've actually set it up as if it's 100, but then whatever your score is, I'll double it. If you make 90 out of 100, that'll be 180 out of 200. It's easier to see how you did if I set it up on a 100-point basis to begin with. A tad over a third is questions, all multiple choice. The other 2/3, approximately, is problems, all multiple choice. And in a lot of the problems, like one of the ones today, you're going to be given more information than you need. Your job is to figure out, based on what the problem is asking you to find, which values provided in the problem you use. And that's all I have to say about that, as Forrest Gump would say. That's all I can think of.
Dr.
Any-
Card, is
Go
it
ahead.
gonna be divided by chapters, or it's gonna be all mixed up?
Well, it'll all be mixed up like it would be on a regular exam.
Okay.
I mean, there'll be a multiple choice section that's all together of questions, I'm sorry. The questions will be one section, the problems another. And actually, the problems will be scrambled. So
Okay.
even if I had set it up in original, chapter 8 and chapter 9 and so on, it'll be mixed up. So it'll be mixed up.
Thank you.
Mhm. Any other questions? I'll fix these slides, then send the fixed copy back out to you, probably email it to you. In fact, I may do that in a matter of minutes. Also, if you will, be looking at that memory aid that I sent to you. And if you see any mistakes on it, let me know so I can fix it and get it back out in fixed shape. I don't think there are mistakes on it, but then again, it's me that made it, so who knows? Today's Wednesday. Monday, we'll finish off this chapter. And with the remainder of the Monday class and the Wednesday class of next week, I'll be available to go through any problems you want me to go through. You need to go through your slides and notes for the question portion of the exam. And to prepare for the problem portion, obviously look at the problems in the slides try to work the extra problems that I gave you that are in green text, you know, like the Wind Corporation problem today. And also attempt the assigned problems out of the book. The check figures for those problems are in the back of the book at Appendix B. If you fail to get a check figure and you don't know what you did wrong, by all means, contact me. Simplest thing to do, you know, you're going to take scratch paper when you work out these problems. If you don't get the check figure, just take a picture of your work and email it to me. And then I can respond and hopefully show you where you made a mistake, if you did. Oh, and one other thing. I think I sent you out something about evaluating the class. Please do that. I won't see it probably till next fall, to be honest with you. And I won't know who made what comments or marks, but I like to get that feedback to know what I'm doing right and what I'm doing wrong and where I can improve. Any other questions? Okay. Stay safe. I'll see you Monday.